Well, hello, everybody. Welcome back to Finspire's Focus on the Market series. I'm Chris Kasem, Chief Investment Officer with Finspire. This time, we want to take a recap in America's Top 10. We're going to look at 10 charts that sum up 2022 and give you a look ahead to 2023. Now, I know 2022 may not have been the most memorable or favorable year in the capital markets, but we can learn a lot from what we've experienced and also make some comparisons to previous years that looked a lot like 2022 and conclude what could be ahead of us this year in 2023. All right. So as you know, we always have different types of things. America's Top 10 was a deviation of America's Top 40. Now, when we were growing up, we were always listening to Casey Kasem on the weekends. Casey Kasem there on the left. First show, American Top 40, came out July 4th, 1970. The number one hit song that week was the Jackson 5, The Love You Save. Great song. But I look at these markets as I get the question a lot, when are we going to return back to the top? The peak that we saw January 2nd, 2022. And yeah, we've had to be more patient this time around because of the interest rate and inflation adjustments. But we'll talk a little bit about that as we make our way through and have some fun along the way looking at previous year's top songs. All right, so if we sum up 2022, it was all about inflation and interest rates, creating the worst bond market on record. And so not just difficulty in the equity market, but bond market as well. We had a contracting economy, Q1 and Q2. You could argue it was a recession, but it rebounded in the third quarter, and it may have rebounded further in the fourth quarter. We'll see. We'll get our first reading on GDP on fourth quarter GDP at the end of January, but growth this year is definitely in question as a result of those higher rates. But consumers kept spending. The labor market's still pretty tight, and so you have this counterbalance to these projections of a deep recession with this reality that labor is still in high demand, despite the fact that we have higher wages. Commodities surged in 2022. We'll talk a little bit about that. They elevated, especially after Russia's invasion of Ukraine, and then they plateaued. And then we're going to talk a little bit about overseas equities, kind of a hidden gem in 2022 that may be telling us what could be what could tell us what could be in the future here in not just 2023 but potentially beyond. All right. So let's hit asset class performance. Top performing at the top, least performing asset class at the bottom. Commodities that I mentioned ran up in the first quarter, plateaued quite a bit. So this hasn't moved much in the last couple quarters, but commodities as a broad basket is up 16% in 2022. You can see that fixed income down 13%. And you can see here EAFE, Europe, Australasia, Far East Index. Basically what that means is developed non-U.S. stocks. Finished ahead of the S&P 500 by a reasonable amount, by over 4 percentage points, and a lot of that ground was made up in the fourth quarter as we saw a rotation in the U.S. dollar, and I'll get into that a little bit more. Also, emerging markets, which started to surge in the fourth quarter, and they've also had a good start. International stocks have had a good start to 2023 thus far, just a couple weeks in. Number one song from Billboard, 1962, Frankie Valli and the Four Seasons, Sherry. That was a big hit. They actually had two number one hits that year in 1962. But why 1962? Actually, our friends over at LPL Research did some work on this and looked at the highest correlating year to 2022 was actually 1962. And 60 years ago. And as it turned out, a lot of the similar factors were at play in the markets in 1962. And if you're wondering, 1963 turned out to be a pretty good year in the equity market. Not saying that's going to be a repeat, but it was interesting to see that research about what was the most highly correlated year to 2022, because we tend to use the words unprecedented a little bit too many times. So let's take a look at some perspective here about what this down year of 2022 really means. Really, since the start of 2019, the S&P index is still up cumulatively 53%. Since the COVID peak of February 2020, the markets are still ahead by 13%, clearly not as much as they were if you'd started investing in theoretically in the beginning of 2019. And obviously, since the January 2nd, 2022 peak, the S&P was off 20%. I used the American Top 40 number one song from January 5th, 2019 to give us a recall of how good it was to be an investor in the beginning of 2019. Panic at the Disco, High Hopes. Fun song. And we've got some high hopes for 2023, but really looking out beyond that as well because of some of the bargains that we see in the equity market today and in the bond market. Leading economic indicators are decaying. So we do see every time, and you can see in this recent past, when economic indicators start to go in the beige or below that 0% line, we tend to get a recession that follows. And that wouldn't surprise us. In fact, most The most likely outcome is that we do get a recession in third quarter, second quarter, third quarter, or fourth quarter this year. But the question is, how big of a downturn will it be? Well, what I can tell you is that I purposefully gave this, looked at the American Top 40 number one song from December 1st of 2007, which was One Republic's Apologize. That was a big hit. Because I'd also wanted to make sure that when we look at historical comparisons, we don't think we're entering into something like the Great Financial Crisis, where we had mortgage meltdowns, banks go under, et cetera. Banks are much better capitalized today. So looking at this market compared to December of 2007, I think is inaccurate. Okay, one of the strong parts of the economy has been the labor market. Unemployment rate's low. It actually dipped back down to 3.5%, but the participation rate is low. In fact, it's well below where it was pre-COVID. As you can see here, where we are here, it's been stubbornly low post-COVID. Early retirements, baby boomers retiring. You've got in the data, it shows that 7 million men are not working who are of working age between 25 and 55. It's a bit of a question mark, but what it does do is actually throughout 2023 and beyond, it may limit the damage done by a slower economy, which you ordinarily would then see higher levels of unemployment. We may not get all of that unemployment because labor is still in demand, which is a good thing. And it's also putting some uncertainty as to what a recession would look like if we had one, or how we may not even have a recession because of this factor and because of labor being such in demand. All right, Billboard number one song, January 8th, 2000, which was the peak of the labor force participation rate before all the baby boomers started retiring. Santana featuring Rob Thomas, Smooth. That was a heck of a hit. 12 weeks at number one. Fantastic. All right, earnings. Earnings have held up relative to expectations of the last few quarters. Analysts keep estimating that's going to tail off, and it hasn't done that quite yet. And earnings are really important because they give us not just a path about a view into how a company is performing, but also those are the longest drivers. The drivers of long-term growth really are in fundamentals or in earnings. And so we'll be eagerly anticipating first quarter earnings. Let's see if they remain above average. So far, it's early in the earnings season. Fourth quarter earnings season's been kind of mixed, but we'll get a lot more here as we progress throughout the quarter. Billboard number one song from March 10 of 2000 was Amazed by Lone Star. So a country band got into the top of the Billboard number one March 10 of 2000. I point that out because that's when the tech bubble burst. And people are asking me a lot, does this look like the tech wreck of 2000? Somewhat. There are some similarities between what happened between 2000 and 2002. However, we think a lot of those high-flying technology companies this time around, the ones you know very well, actually have strong earnings. And that's a big difference between 2000. However, the rotation to value, the rotation to small cap, the rotation to international actually has some resemblances that are developing that were very similar today than what they were 22 years ago. All right. Now, I raise that point because when we look at earnings and valuations around the globe, we always reference the S&P 500 as a reference point, just as a metric of U.S. large companies. But that's not the only place to invest. U.S. small cap, overseas markets, emerging markets, all have pretty attractive combination of valuations, meaning lower price to earnings ratios, and earnings growth that can be higher or adequately higher than their earnings levels relative to U.S. large companies. And so we do see some opportunities overseas. We see opportunities in U.S. small cap and also emerging markets. In other words, good time to be diversified in the equity markets. American Top 40, number one song from December of 2017, Ed Sheeran, Shape of You. That was a good one. All right, now here's why I point out that point in time. 2017 was the last time that emerging markets topped the asset allocation chart above everything else, and it could be what's happening. It could be what happens in 2023, especially as those emerging economies start their monetary easing, or they stop raising interest rates well before we have. We haven't gotten there yet, but they already have, and so they might even be cutting rates to spur economic growth. So that could be a good sign for emerging markets. All right, inflation. We've learned a lot about inflation over the past year. how it just ripples through the economy, how it ripples through the markets, and the impact on rising rates, et cetera. We're off our peaks. We're off our peaks substantially from last June. We still see some pockets of data that gets us a little nervous, but we do see a clear trend downward in inflation. That should allow the Federal Reserve to curtail their interest rate increases and start to plateau or put a pause to that policy moving forward. The last time we had inflation like this, we have a little fun with this one. American Top 40 #1 song from December of 1981, Olivia Newton-John, Physical. Wow, that was the last time inflation was at these levels back in 1981, and we lost Olivia Newton-John in 2022. It's too bad. Treasury yield curve. All right, yields are. This is actually a good news, bad news slide. And there's a lot of good news here. Good news meaning that yields have stopped going higher. You can see quarter over quarter, not a big change in the yield curve, with the exception being in the very short end, which the Federal Reserve controls. Now, the bad news is that yields are starting to not just plateau, but starting to fall. And what that usually precedes is when those yields fall is a telltale that there's a recession coming. And again, we just don't know what that is going to look like, how deep it is, whether it's going to be mild or whatever. I don't like to use those particular terms, but there is going to be slower, if not negative growth in the forthcoming quarters, is really what the yield curve historically tells us, and they've been wildly accurate. But that being said, this still represents the great opportunity in bonds. Bond yields being at this level, much greater than they were in December 31st of 2021. You can see the 10-year yield almost a little over 2.3% higher than it was to finish 2021 today. And these are yields that we haven't seen in over 15 years. So it's a great opportunity to jump in. Now, what's the song on this playlist? American Top 40 #1 song from August 11, 2007, Fergie, Big Girls Don't Cry. I don't know what happened to Fergie, but a lot like in 2007, those yields, that last time the 2-year yield was at 4.41% was in August of 2007. And I can tell you that what happened afterwards was a big drop in yields, primarily due to the big recession that we had. My point being, not that we're going to another great financial crisis, which I talked about earlier. However, my point is that these yields will not last likely very long. Okay, so when you see short-term yields at this level, you try to capture them to the point that's appropriate based on your risk profile, because they probably won't last long if history is any indication. All right. We haven't shown this chart in the past, but we thought it was important. We've been thinking a lot about this chart over the course of 2022 and thought we'd share it with you. The strength of the U.S. dollar. Strength of the U.S. dollar rallied big time in 2022, rallied 28%. What'd that do? That made companies who made their earnings overseas and translated back into U.S. dollars, it made their earnings look not so good. Well, now, after that big rally in the dollar started to give way, started to weaken in the fourth quarter, we saw a rotation of that. So what does that mean? That means for us as U.S. investors, foreign investments look more appealing because when those earnings are translated back into U.S. dollars, we get more money. We get more of a return. And so this is actually a really important chart. These trends tend to last a long and extended period of time. Dollar strength, dollar weakness. And what that could foretell is something that we saw in 2002. So the American Top 40 #1 song from June of 2002 was Vanessa Carlton, 1,000 Miles. I know it feels like we're 1,000 miles away from the international stocks outperforming U.S., but the reality is it happened last year. And if you look back at this time at 2002, which was the last time the dollar was this strong, as it exhibited after the third quarter of 2022, and then started to weaken, we saw a 5-year stretch, almost 5-year stretch of outperformance of non-U.S. equities relative to the U.S. So history could repeat itself there. All right, another chart that we've been watching closely, but we haven't shared with you yet in these videos is gold. We get a lot of questions about gold. Is now a good time to buy precious metals? Is gold a good investment? Gold held its own well. It's known for preserving its purchasing power. It's as a hedge, inflation hedge. It's also known as a good hedge against global unrest. Guess what? We have all of that going on. We also have a debt ceiling debate happening, et cetera, et cetera. Gold does, however, from a technical indicator perspective, look somewhat attractive and can be a good diversifier in a portfolio. And we tend to get that as well as interest rates start to fall. So as interest rates start to fall, the value of that U.S. dollar tends to weaken, just like we saw in the previous chart. and gold seems to be attractive during those periods of time. So it's could be a good inclusive element to a diversified portfolio. All right, now you might be wondering, now why do I have on the playlist here the Billboard #1 song from August 15th of 1971, the Bee Gees. Wow, one of the greatest selling artists of all time, the Bee Gees. Well, they had #1 hit, How Can You Mend a Broken Heart? Well, that week in 1971 was actually the week that President Richard Nixon formally, although it had been happening informally for years, formally detached gold as being a backer of the U.S. dollar. And so just a little fun fact there, but nevertheless, gold looks appealing, especially as interest rates come off their highs, and also as demand for gold from other countries and other central banks rises across the globe. All right, what do we do now? We mentioned this phrase, playing offense in a defensive market. Continue to do that. Whenever bonds offer potential equity-like returns, take it. Okay, rebalance the portfolios. Now that these yields are higher, it might make a lot of sense to rebalance. Take advantage of these higher yields we haven't seen in over 15 years. So this could really impact how much you need your equities to perform in order to meet your investment targets. Diversify. I think you've seen throughout the presentation here in these top 10 charts, it's not just about diversifying bonds, into bonds. It's also about diversifying your equity exposure, large cap, small cap, international, because we can see pockets of potential outperformance relative to U.S. large cap stocks in different sectors of the globe. And then lastly, continue to be patient. We talked about this the last couple quarters. We're in a period, there's this phrase, don't fight the Fed. It's also important to be patient because we were on a tailwind from the Fed for, especially in 2000, after the COVID response, the economic response to COVID was a forceful of money going into the system, and now it's being curtailed and withdrawn from the system. So we just have to be patient and let companies heal on their own and allow for equities time to perform. All right, now disclosure. I mentioned this our disclosure, but you might say, why is there a picture of Shaggy and Scooby-Doo here? Well, back to the start, when we talked about a little about Casey Kasem, he was always on the radio when we were kids, but he was a really hard-working guy, and we always appreciated it. And because of that, he was also a big radio and audio person, not just with American Top 40, but he was the voice of Shaggy, believe it or not, starting in 1969. So pretty amazing guy, and did some really neat things, including being the voice for Shaggy. So with that, I just want to say thank you. Thanks for listening. Thanks for tuning in. We hope you love these, enjoy listening to these videos as much as we enjoy producing them. And as Casey Kasem used to say, keep your feet on the ground and keep reaching for the stars. That's what we'll do as we close this program like Casey Kasem did every American Top 40. Cheers to a healthy and prosperous 2023. Talk to you soon. Bye-bye.